Hello, fellow traders. Position sizing is one of the most important yet underappreciated skills in trading. Today we'll explore how to manage risk effectively, maximize returns, and we'll use the SPY as a real-time example to demonstrate these principles. Today we're going to get into position sizing simplified, how to go big on winners and cut losers early by Pajama Trader. Give this a like and subscribe. Let's get into it. What is position sizing? Position sizing determines how much capital to allocate to a trade based on the account size and risk tolerance. It's the foundation of risk management, ensuring you survive the losing streaks and capitalize on the winning trades. For example, risking 2% of $10,000 in an account means risking $200 per trade. Position sizing is about balancing risk and reward. It ensures that traders can withstand market fluctuations while maximizing potential gains. For instance, risking a consistent percentage of your account helps maintain stability regardless of market conditions. Why position sizing matters. Proper sizing prevents overexposure to risky trades, enables traders to maximize profits by scaling up on winners, and protects portfolio integrity during volatile periods like SPY corrections. Position sizing is crucial for long-term success. It prevents over-leveraging, which can lead to devastating losses during market downturns. By scaling winners and cutting losers early, you can protect your portfolio while maximizing returns. Core methods of position sizing. There are three main methods: fixed percentage, volatility-based, and fixed dollar amount. Each has its strengths and weaknesses. For example, the fixed price percentage method scales with account growth, while volatility-based sizing adapts to market conditions like SPY fluctuations. Each method has its advantages and disadvantages. The choice depends on your trading style and market conditions. For example, volatility-based sizing is useful during periods of high market volatility. Real-time example using the SPY. Using SPY options as an example, we can demonstrate how position sizing works in practice for a small portfolio. Assume a $2,000 account with a 2% risk tolerance per trade, meaning the maximum risk is $40. Let's apply the two simple scenarios: buying a call option, bullish outlook, and buying a put option, bearish outlook. Call option scenario, bullish outlook. Suppose the SPY is trading at 597.21 as of February 27, 2025. You believe the SPY will move higher and decide to buy a 610 call option, expiring in 2 weeks. The premium for this option is $40 per contract, or 40 cents per contract, equaling $40 since each contract represents 100 shares. Position size calculation. Maximum risk per contract, $40, the premium paid. Maximum allowable risk, $40. Since the premium aligns with your risk tolerance, you can purchase one contract. If the SPY moves above 610 before expiration, the option's value increases, and you can sell it for a profit. For example, if the SPY rises at 615, the intrinsic value on the option would be $5. 615 minus 610, the $5 profit, making the contract worth at least $500. If the SPY stays below 610, by expiration, your maximum loss is limited to the premium paid, $40. Now suppose you suspect that the SPY is going to decline and decide to buy a 590 put option, expiring in 2 weeks. The premium for this option is also $40 per contract, or 40 cents per contract, equaling $40 per 100 share for the 100 shares. This trade allows you to profit if the SPY drops below 590. Position size calculation. Maximum risk per contract, $40, the premium paid. Maximum allowable risk, $40. Since the premium aligns with your risk tolerance, you can purchase one contract. If the SPY falls below 590 before expiration, the value of the put increases. For example, if the SPY drops to 580, the intrinsic value of the option would be $10, 590 minus 580, making the contract at least $1,000. If the SPY stays above 590 by expiration, your minimum loss is limited to the premium you paid, $40. The options provide flexibility for both bullish and bearish market outlooks, while maintaining a defined risk. In these examples, if the SPY option allows you to profit from an upward move on the SPY, while capping your loss at just 2% of your portfolio, this put option allows you to profit from a downward move in the SPY, while similarly capping your loss. Both trades align perfectly with the small account risk tolerance and demonstrate how position sizing applies to basic option strategies. Whether you're bullish or bearish, maintain discipline with position sizing ensures that no single trade jeopardizes your portfolio while giving you the exposure to significant gains. Scaling winners and cutting losses early. Increase position size incrementally as trades move in your favor. Use trailing stop losses to lock in profits while allowing winners to run. Exit losing trades quickly to free up capital for better opportunities. Scaling winners with SPY. Initial entry. Assume you enter a position when the SPY breaks out above 600 on strong momentum. You purchase 5 shares at 600 with an initial stop loss at 590, risking $10 per share. The total risk on the initial position is $5 times 10, equaling $50. 2. Scaling up. As the SPY moves higher, you add to your position incrementally. For example, add 2 more shares when SPY reaches 610. Add another 2 shares when SPY reaches 620. At each step, adjust your stop loss to protect your gains. For instance, move the stop loss to 605 once the SPY reaches 610, and move the stop loss to 615 once the SPY reaches 620. 3. Using trailing stop losses. A trailing stop loss can be set at 2% below the current price. For instance, if the SPY moves to 625, the trailing stop loss adjusts automatically to 612.50, 2% below the 625. If the SPY reverses and falls below this level, your position is closed, locking in profits. Cutting losses early. If the SPY fails to hold above 600 and drops back below your initial stop loss at 590, you exit the trade immediately. This limits your loss on the initial position to just 50, preserving the capital for future opportunities. Scaling winners is a powerful way to maximize returns during strong trends, while keeping risk under control. In this example, starting with a small position when the SPY breaks above 600 allows you to test the strength of the move before committing to more capital. Adding more shares incrementally as the SPY continues higher ensures that you are increasing exposure when the trade is working in your favor. Trailing stop losses are essential for protecting gains without prematurely exiting a profitable trade. By locking in profits as the SPY moves higher, you avoid giving back substantial gains if the market reverses unexpectedly. At the same time, cutting losses early is equally critical. If the SPY fails to hold a key level, like 600, and drops below your stop loss at 590, exiting quickly ensures that your losses remain small and manageable, freeing up capital for better opportunities later. Tools for efficient position sizing. Utilize tools like the ATR, average true range for volatility-based trading. Trading platforms with built-in calculators and journaling tools to track performance and refine strategies. Tools like ATR simplify volatility-based position sizing by helping traders adjust their exposure based on market conditions. Journaling every trade allows you to analyze performance and refine your strategy over time. Common pitfalls in position sizing. Over-leveraging. Traders often use excessive leverage to amplify potential gains, but this can lead to devastating losses during market downturns. For example, a small adverse price movement can wipe out an account if over-leveraged. Emotional bias. Emotional decision-making, such as increasing position sizes after a winning streak, recency bias, or doubling down after losses, gambler's fallacy, often leads to poor outcomes. These behaviors stem from overconfidence or desperation and can erode capital quickly. Ignoring diversification. Concentrating on positions in one asset or sector increases vulnerability to market-specific risk. For example, allocating the same position size to highly correlated assets can lead to compounding losses during adverse events. Failure to adjust for volatility. Using the same position size regardless of an asset's volatility exposes traders to excessive risk. Volatility-based sizing, such as using the ATR, average true range, helps mitigate this issue by scaling positions appropriately. Overtrading. Opening too many positions simultaneously spreads capital too thin, making it harder to manage trades effectively. This often stems from emotional reactions to short-term market fluctuations. Common pitfalls in position sizing include over-leveraging, which magnifies both gains and losses, and emotional bias like recency bias or gambler's fallacy that can lead to impulsive decisions. Ignoring diversification or failing to adjust for volatility are also critical errors. For example, traders who ignore volatility take oversized positions in highly erratic stocks, increasing their exposure unnecessarily. Discipline and adherence to predefined rules are essential for avoiding these traps. Key takeaways and action plan. Define risk tolerance. Before entering any trade, assess how much of your capital you're willing to lose on a single trade. Use methods like fixed percentage risk, example, 1 to 2% per trade, to maintain consistency and limit drawdowns. Tailor position sizing to market conditions. Use strategies like volatility-based sizing, example, ATR, average true range, or fixed dollar allocation depending on the asset and market environment. For example, reduce position sizing during volatile periods or when trading in highly erratic assets. Focus on scaling on winners. Allocate more capital to winning trades during strong trends while cutting losses early. This Andy Martingale approach will and help maximize gains while minimizing losses. Diversify effectively. Spread your risk across different assets and sectors rather than concentrating on one trade or correlated positions. This reduces vulnerability to sector-specific downturns. Use stop-loss orders. Always set stop-loss levels based on your predefined risk tolerance to prevent large losses from unexpected market moves. Effective position sizing is the cornerstone of successful trading. Start by defining your risk tolerance. This ensures that you stay within acceptable loss limits, even during adverse conditions. Tailor your approach based on market conditions. For example, use tools like ATR for volatile markets. focus on scaling winners like SPY during strong trends while cutting losses early. A disciplined approach that compounds gains over time. Diversification is equally critical. Never concentrate your portfolio in one asset or sector. And finally, always use stop-loss orders as a safety net against unexpected price movements. By implementing these principles consistently, you refine your trading strategy and improve long-term. Thanks again for watching. If you find value in this video, please give it a like and share this video with other like-minded traders looking to improve their trading game. And also consider subscribing for more Market Edge videos and market alerts like this. Thanks again.